Welcome to Inside India. I'm Amitod Singh. These are your headlines. India's economy expected to have grown 7.4% in the fiscal year ending in March, crushing forecasts and making it the world's fastest growing major economy, despite uncertainty about US tariffs. Also, Commerce Minister of India, Piyush Goyal, heading to Brussels as India looks to advance trade negotiations with the EU. Also, Indian equity markets will be trying to shake off their losing streak after 3 days of losses as attention also turns to earnings season. All right, APAC markets, what are they reflecting? Foreshadowing mixed markets in the US. The S&P 500 was down 0.3%. The Dow was down nearly 1%. Nasdaq was it was up nearly 0.2%. But two major developments clearly hurting the APAC vibe. You see almost a sea of red. Apart from two, Trump saying he won't permit defense companies to issue dividends or stock buybacks unless they actually address certain complaints. And CNBC breaking the news that the US will effectively be the gatekeeper of all revenue and oil business coming from Venezuela, starting with the first tranche of that 50 million barrels to the US announced by Trump earlier. Oil prices dropping as a result of that, as did Japan's Nikkei, the TAIEX, the Hang Seng in Hong Kong, the FTSE Bursa. But the Kospi showed resilience, up about 0.75% at this point in time, up about 0.58%, as all eyes really are on Samsung Electronics and their earnings results that we're watching very carefully. The Indian markets, they come online in about 45 minutes. GIFT Nifty Futures has been indicating a positive side, but at this point in time, it's down about 0.1%. 26,173 is where it's at. But remember, there are a couple of things that are building up to that cautious sentiment. A third day of consecutive selling is a result of geopolitical tensions, Venezuela, no end in sight of the India-US trade dispute, and also that perhaps Indians are saying, let's go to gold, let's go to other precious metals as a safe haven. They climbed again, those precious metals. Also, the Supreme Court in the US expected to give some sort of judgment, perhaps around Trump's tariffs on Friday. A Reuters poll also saying, as we're watching the Indian rupee, that the rupee will strengthen to about 89.75 by end March. Right now, 89.94 is where it's at. The Reuters poll also saying that it will trade around 90.3 end June. So it is going to continue to rise, even if there is some sort of defense coming from the Reserve Bank of India. So let's dive into the numbers that we got 8 p.m. India time yesterday. India's economy is expected to grow 7.4% in the current fiscal year ending March, beating the government's earlier forecast of growth between 6.3% and 6.8% by a lot. That's official data now. Growth is being supported by stronger private consumption, rising government spending, and a rebound in manufacturing. This despite the economy facing hefty US tariffs and global uncertainty. The nominal GDP growth is seen at 8%, lower than last year, while private investment is expected to pick up. The estimate will also somewhat form the basis of India's federal budget, which is due on Feb the 1st. Meantime, India's Commerce Minister Piyush Goyal is in Belgium today. He will be meeting the European Commissioner for Trade, Maros Sefcovic, to iron out differences in the proposed free trade agreement between India and the EU. The deal was expected to be concluded by the end of last year, but sensitive issues around market access and regulations remain unresolved. All right, let's bring in our guest for the day. Sanjay Mathur is the Chief Economist for Southeast Asia and India at ANZ. Thanks so much, sir, for coming back. Happy New Year. It's great to have you. Yeah. We were chatting, when we were trying to think about how the Reserve Bank of India would cut rates or not. I want to start by understanding the latest that we've just got from a Reuters poll around the Indian rupee, strengthening to about 89.75. You heard me say that this is by end March, but it's going to trade in June at about 90.3. Do you have an updated take on that?
Well, we think the rupee is going to be fairly flat, slightly above 90. And the rationale for it is that we do not know as of now when the tariff issue would be resolved. Second, the overall BOP has been fairly flat. Now, I do concede that if there is a tariff announcement, some kind of deal being reached, we don't know when, we will see a snapback in dollar rupee. But that would be a short-lived one. I think overall what we are seeing is that corporate earnings relative to nominal GDP growth, they have been fairly weak. And unless that dynamic changes, I cannot think why portfolio flows will come in on a sustained basis. Now, there is one more thing, which is India bonds may be included in another large index. That would obviously be positive. But having said that, I think the experience of the last inclusion was that it perked up only for a short period of time. And then after that, again, it sort of started to stabilize or fizzle out. So I think there are too many pulls and pushes. Put on that, I think we are of the view that the rupee will trade above 90 for a considerably long period of time.
By the end of 2026, what's the number that you're thinking?
We're looking at slightly close to 91-ish. So effectively, it's a flat forecast.
Okay, interesting that you mentioned tariffs. Geeta Gopinath, perhaps one of the most respected voices globally, but more for India. Whenever she speaks, India watches and listens. As a leader of the IMF, effectively, she's just come out with an article in the Financial Times where she said that so far, if you've been excited about the fact that the impact of tariffs has been muted, well, don't be, because you're going to see that impact now play out, and perhaps most in a place like India, which has the highest tariffs globally at 50%. How do you read that?
I think in the Indian context, that could be a reality. And the reason why I say it is that initially you had front loading. Then you had sort of hopes of, oh, well, tariffs, they will be lowered very soon, etc. So the momentum kind of stayed. Now, if I say that, the expectation was this was going to happen in November, we are now in January, and now there is greater uncertainty whether it's going to be resolved anytime soon or not. That means that US buyers are going to be a lot more sort of cautious in terms of placing new orders going forward.
Right. Interesting. In that context, you have the GDP numbers, which project 7.4% growth for the fiscal ending March. That's great compared to even Vietnam, which is a competitor in that sense, in terms of one of the few countries that is growing fast, but India is 8 times bigger as an economy. The rest of the countries are just like 4%, 3%, 2%. So India is a great story at the end of the day. So, I mean, are economists, are investors, in your view, buying that number as 7.4%? And when you have this looming issue of tariffs and at the same time foreign direct investment not coming in?
So let me answer that in two parts. The first point is that the macro momentum in India is decent. Having said that, I think if you look at the issues around the GDP deflator, etc., there is clearly some degree of I would say, overstatement of the numbers without diminishing the fact that momentum is pretty good still. And that arises due to the fact that, you look at nominal GDP and you look at real GDP, they're so close to each other. Second, if I look at things like, say, the BSE 500, are earnings really keeping pace with GDP growth? Not so much. So there are pockets of weaknesses as well. So I would say that, yes, no one denies the fact that momentum is strong. At the same time, there is some sort of circumscription about the number itself.
Yeah, which is changing. Feb 28, there's the new base year.
Which should change.
By that time, we'll have updated numbers for not just this year going forward, but also the last 3 years. So things will change, and perhaps the budget will factor that in.
The budget should factor it in.
Yeah.
And I think that one of the big changes is we will be moving to a double deflator approach, which will sort of provide more, better numbers, I would say, closer to reality.
Right. Those are important aspects because we had the old base year was 2011. Now we're going to 21, 22, or 22, 23 actually, which is really going to change the way we look at data completely. I want to talk about nominal GDP. It's which is basically, for our viewers, the actual output in the country this year without adjusting for changes in prices. It came in, at only 8%. The Ministry of Statistics saying it's 8% when economists had expected it to be at about 8.3%. And when you account for inflation, that's low, the nominal GDP. Even if it's higher compared to other countries globally, bottom line is that for India, that's not a good picture.
Yeah, I think that the gap between real and nominal GDP is very low.
7.4 and 8.
Yes, that is very low. And I think that to some extent, nominal GDP is, so last year we had low commodity prices. we did not really see wages increase. So your WPI, which is perhaps the best indicator we have for a deflator, was very low. And the second part of it is that our analysis suggests that India's WPI and China's PPI, the correlation has increased. So that's telling you that, competitive pressures matter.
Say more about that. How much do they matter and how much are they correlating?
Yeah. So I think the correlation has increased over the years. Now, when we say that, it doesn't mean that, India is importing a lot from China and that is the reason. What it means is that the ability to raise prices becomes constrained, because if I try and raise my prices, then I know that imports will come in.
Okay. About the nominal GDP, just for context, the 8% that we have projected, that the government has projected for 2026 FI, is way below than the past 10-year average of around 10%, way below the 20-year average of about 15%. And at that time, inflation was much higher than it is right now, so that was great. But it's not like nominal GDP is going to pick up in the coming year, even if you have this base year change, most likely. In fact, it's going to drop. And that is going to mean that India's GDP is going to be much lower. How does the government fix that problem of nominal GDP, even if inflation they allow to rise?
So I think there are two parts. I do think nominal GDP in FY27 will be somewhat stronger.
Okay.
Reason being, we started to see commodity prices have gone up a bit and all that. So you've got that situation. The second thing is, how do we fix it? And this is really comes down to monetary policy. You can't fix nominal GDP per se. But does it really change what your neutral rate of interest is? Mm-hmm. Because at the end of the day, nominal GDP is also an indicator of price pressures. Yeah. So should India be really looking at a lower neutral rate than a real neutral rate than 1 to 1.5%? And that's going to be something, that story that would evolve if we see another year of muted GDP deflators.
What do you mean evolve? Which side do you think it's going to go?
Then I think the neutral rate should be lower.
So will they do that? Because you've had other economists effectively say that, look, for a growing economy like India, you need it to be at 1%, 1.5% perhaps.
I don't think there is any sort of benchmark to this. And the reason why I say it is that perhaps, benchmark holds for a certain period of time when the global growth inflation picture is different. Now we are in a different environment.
Yeah, fair enough. Just talk to us about how does an RBI look at these numbers in the present context?
I think for now, in the short term, they should be very content. Because the growth number, at least at the headline level, and it also matches our own forecast, we are at 7.3 for the year. Yeah. I think that, it gives them a good sort of anchor. I think what it allows them to do, however, if they choose to, I don't see any reason why, they would be lowering rates in the next policy meeting, simply because we don't have enough data right now, high frequency data for January or, December.
Although indicators are that they will. I mean, in terms of the commentary that we've seen.
What they said was that we can keep rates low for a prolonged period of time. It does not mean that rates are going to go down from here. Last time we were very sanguine on a rate cut.
Sure, but it doesn't also mean that they're going to keep rates where it is. It perhaps means more that they will actually reduce rates.
Absolutely.
Than
I think that if high frequency indicators are disappointing, they do have the flexibility to cut rates. I'm saying that it's a little early to come to that conclusion that it is a certainty at the next meet.
Okay, fair enough. There's just so much happening. Fiscal deficit target that the Indian government has after this, latest Ministry of Statistics data that we've got about 7.4% for the GDP year. Is it okay? Are we meeting the fiscal deficit, and does the government have to worry about it in the budget?
I think we can meet it this year. For that is
slightly lesser, you think?
No, I think it'll be roughly there. Okay. And the reason being, where sort of revenues or tax revenues have disappointed, but I think there are non-tax revenues such as the RBI dividend which will make up. Next year, the situation will be a little more challenging. I think that for them to incrementally reduce the deficit will be difficult. And the reason why I say that is because in the last few months, your revenue buoyancy has fallen a lot. Now, you need it to improve tremendously to sort of get there. And that's going to be a challenge.
When you have this target that the government is trying for 4.4% of GDP deficit target by March 2026, and you have the looming tariff uncertainty, you have FDI is not as exciting as they should be, and you have the budget coming on Feb 1st, and you've already done so many structural reforms. What do you do? What reform can you meaningfully bring that is going to change the situation in line with your own stated ambitious goal of a developed economy by 2047 that economists like yourself say should be at 9%, our GDP should be at 9%, our growth rate should be at 9-10% for that?
Yeah, I think
what do you do in the budget? I don't get it.
So I actually think that fiscal policy will be relatively neutral to growth this year. I do not see, in terms of what new stimulus fiscal policy can provide. But over a period of time, I do think that further reforms around labor, land, these are things that, should gain momentum.
Transmit, you mean?
Transmit.
Okay. Put this in the global perspective. When you don't have FDI coming, FBI is also leaving basically, and you have the following, that India's growth is so much better than other major economies. The US, real GDP growth at 2%, China at 4.5%, Brazil at 2.5%. Sure, Vietnam is around 7%, but India is still bigger and better in that context. Why is India's growth story just not the best for 2026-27? Why is it a concern still?
So the concern is, as you said, the aspirational growth rate isn't there. Second, as an FPI investor, what am I looking at? I'm looking at corporate earnings should grow at sort of consistent with GDP growth, and we haven't seen that. So that's the second concern. The third issue is that on the point you make about FDI is correct, but there is a change in FDI as well. So we are getting a lot more FDI into things like GCCs, etc., which are not that capital intensive.
This is narrative but not data backed. Like, we don't know the numbers behind how much GCCs are changing the situation for the Indian economy.
No,
or offsetting.
I'm not saying they're changing the situation drastically, but they do hire a lot. Second, I think that if we just look at cities like Bangalore and Hyderabad, certainly their growth rates have been very good.
Okay, we have to talk about corporate earnings next time. Once they actually come in, they started to trickle in. Thanks so much for that. That was Sanjay Mathur from ANZ. Much appreciated that he could come to the studio once again. Now, coming up, after Trump's pursuit of Venezuelan oil, the chatter around his quest to acquire Greenland has increased. We'll get you the latest developments after this break. Welcome back. Let's get you the latest on what's happening in Venezuela. The world's eyes are, of course, on that nation. The U.S. has seized a Russian-flagged oil tanker in the North Atlantic after more than 2 weeks of pursuit. Around the same time, U.S. forces also boarded another tanker in international waters near the Caribbean. Russia described the move as, quote, outright piracy and a violation of maritime law. Oil prices in Asia trading slightly lower. Earlier, at this point in time, you're seeing the light crude at 56.17, Brent at about 61.6. CNBC's travel and transport reporter Monica Petrelli joining us now with the latest on everything that's happening regarding that. Monica, what's going on?
Yeah, well, if we continue to look at those oil prices that you just pointed out there, we just continue to see the market not really react here in a big way. And that's because the potential for Venezuela's vast oil reserves to be a game changer in the futures there, but it's just simply not there yet. And that's despite this announcement from U.S. Donald Trump that Venezuela will be turning over upwards of 50 million barrels of oil to the U.S., which it plans to then sell at market rate. And also with these continued seizures. Now, these seizures, though, maybe not moving the markets very much, but geopolitically, this is a much bigger topic. Not least of which because this has all the makings of like a Bruce Willis 1980s action movie. But, this one yesterday it was called the Bella 1 at one point. This vessel actually avoiding capture some 2 weeks ago, culminating, though, in a seizure, which occurred yesterday south of Iceland and involved forces from the U.S. and the U.K. This is a vessel that in the interim changed its course, changed its name, and changed its flag, now flying a Russian flag. But we continue to see these seizures of these vessels, escalating U.S. Interest in both taking on these sanctioned vessels, but also in running and apparently transforming the oil industry in Venezuela. Now, we saw U.S. Secretary of State Marco Rubio laying out a 3-point plan about how the U.S. plans to do this, which he said includes, yes, a plan to, quote, take all the oil. Take a listen.
Step one is the stabilization of the country. We don't want it descending into chaos. Part of that stabilization, and the reason why we understand and believe that we have the strongest leverage possible, is our quarantine. As you've seen today, 2 more ships were seized. We are in the midst right now and, in fact, about to execute on a deal to take all the oil. They have oil that is stuck in Venezuela. They can't move it because of our quarantine and because it's sanctioned. We are going to take between 30 and 50 million barrels of oil. We're going to sell it in the marketplace at market rates, not at the discounts Venezuela was getting. That money will then be handled in such a way that we will control how it is dispersed in a way that benefits the Venezuelan people, not corruption, not the regime. So we have a lot of leverage to move on the stabilization front. The second phase will be a phase that we call recovery, and that is ensuring that American, Western, and other companies have access to the Venezuelan market in a way that's fair. Also, at the same time, begin to create the process of reconciliation nationally within Venezuela so that the opposition forces can be amnestied and released and from prisons or brought back to the country and begin to rebuild civil society. And then the third phase, of course, will be one of transition.
If we continue on this theme of taking the oil, we saw a very different story coming from the U.S. Energy Secretary Chris Wright. He told CNBC yesterday the U.S. does not plan to take the oil. Rather, it's going to be selling the oil for Venezuela in order to gain leverage over the new leadership, choke off revenue sources, but also ultimately, he said, to return it back to the Venezuelan people.
Monica, I was watching that interview that our colleague Brian Sullivan did, and Brian Sullivan also broke the news that it's not just about the 50 million that Trump posted about on Truth Social. He also basically gave this entire information that, hey, this is just the first tranche, so 50 million. The U.S. is effectively now going to take all the oil that's going to be produced out of Venezuela, become like a, I don't know, middleman or something, control the outflow, the sale of it, manage it. When the revenue comes, put it in U.S. banks, and then take it forward from there. What I don't understand here is when you're chasing other vessels and you have all kinds of understandings around, for example, India, still buying from Russia, and China wanting oil from Venezuela, geopolitically, is this even feasible for the U.S. to take this lead in its own sphere?
feasible, legal? There's a lot of questions here. Much of this will be discussed. But another question is, will the companies come on board with this? The U.S. is not going to foot the bill for this. This is going to be billions and billions of dollars in order to transform this industry. And we're hearing that some of the oil companies, as vast as these reserves are, and as probably as much as they want to get their hands on this in Venezuela, very wary about doing this is because of the volatility really coming from the Trump administration and maybe in just U.S. politics today.
And they're not being able to say that publicly, of course. They're quiet about that. But thanks so much for that, Monica Petrelli, with all the latest on everything that's happening with Venezuela. Now, America's military operations in Venezuela, all eyes on that too, and capture of its President Nicolas Maduro over the weekend has put the spotlight on President Trump's plans for, guess what, Greenland. Greenland is a self-governing Danish territory, rich in natural resources and critical minerals, and a highly strategic position between Europe and the American continent. And the European Union says Greenland is, quote, not for sale, and has vowed to back Denmark if the U.S. tries to break international law. U.S. Secretary of State Marco Rubio announced overnight that he'll meet the Denmark and Greenland leaders next week to discuss America's interests in the island. Now, one company that has a presence in Greenland is Critical Metals. Its U.S.-listed shares have soared, doubling in the past week. Take a look at this point in time, 16.43 up. Since Trump's interest in Greenland really intensified, the company's CEO spoke to us today about its rare earths project in the country, which would make it a significant contributor to the world's supply of heavy rare earths.
If we mine exactly the plan that we've articulated to the public, will control 50% of the world's supply of heavy rare earths. Now, you take that right now, it's China 97%. We get into full production, we'll control 50% of that market. So very, very crucial. We're not the only company, obviously, that has rare earths there, but we're the one that's mining ready. We're the ones that have the exploitation license already given to us by the Greenland government. And we're very, very, very lucky where our deposit is. It is easily extractable and right on the North Atlantic route through the fjord. So everything that we've done over the past 2 years has led us to believe that we'll be able to ship by 2028.
Okay, certain positivity there. Up next, we will take a closer look at what the Indian stock markets will make of the GDP estimates. This is the earnings season also kicks off. Rana Gupta of Manulife Investment Management joins us on the other side of this break for that discussion. We're back in two. Don't go anywhere. Welcome back. This is Inside India. India's markets regulator has accused Bank of America of improperly sharing price-sensitive, non-public information linked to a 180 million block trade in shares of Aditya Birla Sun Life AMC, according to a Wall Street Journal report. Now, SEBI is alleging that the Bank of America staff outside the deal team were given confidential details and that the bank later misled investigators and lacked adequate safeguards to prevent leaks. The Journal says Bank of America is preparing a response and may seek a multi-million-dollar settlement without admitting wrongdoing. The Bank of America declined to comment, while SEBI has yet to respond. We're also watching a General Atlantic-backed Amagi Media Labs. It is targeting a valuation of over $870 million in its upcoming IPO, despite trimming the size of the offering. The Bengaluru-based ad tech firm has set a price band of 343 to 361 rupees per share, aiming to raise nearly $200 million. The issue opens for bidding on January 13th and closes on 16th. The company, which provides cloud-based advertising software for TV and streaming platforms, turned profitable in the first half of fiscal 2026. The IPO comes amid strong investor appetite in India's booming tech listings. We're also counting down to the market open in India. This is what it's looking like right now. As you can see, we're effectively looking at 26,165, but slightly negative. Geopolitical uncertainties. We don't know what's happening with the US tariffs, and we have a Supreme Court hearing that may or may not have a particular judgment impacting India, or else perhaps other aspects of the entire tariff conversation. We're looking also at the rupee, particularly because a Reuters poll has suggested that it's actually going to remain in March, till March, at around that 89 figure, but later in June it's going to hit 90, higher up of 90. Now, Rana Gupta is with us right here in the studio. He's the MD of Indian Equities at Manulife Investment Management. Sir, thanks so much for being here. Happy New Year. You've been with us many a time. I appreciate you coming out here. I just want to start by understanding your impression of how you read the GDP numbers that came out at 7.4%, but nominal GDP was just at 8%. That's perhaps a concern for most people, and economists was talking about that. How does the market look at that? How do you look at that?
So the nominal GDP slowdown is a cause for concern. If you look at the earnings for the financial year 26, the earning growth has deaccelerated from like 12-13% to about 9-10%. This is the impact of nominal GDP slowdown. However, that said, I think it's good news that the real GDP is holding up, because we do expect the deflator, or call it inflation to simplify, we do expect it to pick up going forward. So therefore, we expect the nominal GDP, which came down to like 8% or thereabouts, to pick up to 10-11% next year. As a result of nominal GDP going down, earnings came down, but with nominal GDP going up, we believe earnings will also be at an inflection point.
But the real GDP is also a problem, because the base year is from 2011-2012, which is revised, which is hoping to be revised around Feb 28th to 22-23. So we'll have an entire new basket of goods to look at effectively. So isn't that a concern for the market?
See, I think
that the number will not be 8% or the 7.4% projected. It'll be much lower at about 6.5 perhaps.
Sure. So I think the base change we have to see, but
what do you have to see? Isn't it clear?
So no, of course. Yeah. But 2011 base, and I'm talking about if we look at that base, the numbers that come out, we are of the view that the Indian GDP growth will be, real GDP growth that is, will be between 6.5 to 7.5%. We are not looking at 8%, because to get to 8%, the export growth needs to pick up. With the US tariff situation still pertaining, and global growth not that strong, and India's export competitiveness still a little lacking, we do not expect 8% to happen. So we are comfortable with 6.5 to 7.5.
Okay, and that's with the new base year, of course. Okay, so you said that the earnings have, not fallen, but slowed down a little bit, 9 to 10%. What's it looking like in the next, this season perhaps, and coming up?
So this quarter, earning growth for the broader universe of, let's say, 200 companies that we track will be around 9-10%.
Still?
This quarter.
But we were expecting it. The narrative was that it's going to be slightly better.
It is a little better, but not a lot. But remember, this is still FY26. What we are saying is in FY27, which is the next financial year, we're expecting earning growth to pick up from this 9-10% toward 13-14%.
On the basis of what?
Okay, so that earning growth pickup is very visible, because even if you deconstruct this 9-10% earning growth that is going to come through, that will largely come on the back of auto, banking, and metals. So these large sectors are exiting FY26 on a strong footing, and we expect this momentum to carry through in FY27.
What's not clear to me is that all forecasts are suggesting the GDP of India will reduce in the next year, in the coming months also. But the earnings you're saying will go up.
So earnings are firstly most sensitive to nominal GDP. So if you look at the nominal GDP, let's say real was 7.5, nominal 8. Going forward, we can see 7% nominal, but 7% real, and nominal at 10-11%.
Okay, so let's talk about the sectors that you mentioned: auto, banking, and metals. You're very excited about them. That's interesting. There's another sector that you're excited about: jewelry. We got that through your notes. Thanks for sending them. I was confused about that. And I did some number crunching to understand what's that about. What is it? I think it's 8 billion. 90 billion is the total business that the jewelry sector does. But 8 billion of that 90 is the US market share, exports to the US, which is tariffed very highly, which is why jewelry has been impacted so much. And yet you're excited about jewelry. I wanted to understand that a bit more.
Sure. So to be clear, we are not excited about the jewelry exporters.
Okay.
We are excited about the jewelry which plays the domestic market. Broadly, what we have seen is that with the with the precious metal prices doing well, there is an upsurge in buying activity of jewelry as well as the coins. Domestically. And we like the retailers who are selling them. So to be clear, we like the domestic jewelry retail, not the exporters.
But the domestic upside is going to offset the US downside?
So the kind of companies that we like, they are only into domestic retail. They do not export.
So not the whole sector, certain companies.
Correct.
Okay,
the jewelry retail, if you want to be more specific.
Can you name the companies?
No, we cannot name the companies.
Come on. Okay. You're muted on IT and pharma. You're not very excited about that. Is muted the word that you used? Is it a euphemism for bad?
No, it's muted in the sense if you're looking at, let's say that I mentioned to you that we're looking at earning growth of 13-14%. Typically, you want to buy companies or sectors which will go near there or even beat it, right? Now, you have to view that IT sector, earnings growth will be in mid-single digits. So that's why I call it muted. For pharma, there's a bit of nuance. The large pharma companies which are part of the index, they're very large, and they will also grow in a muted way because there are some base impact and all that. However, within pharma, there is this subsector called CDMO, contract manufacturing. I think that segment will have much higher earning growth. So within pharma, we like CDMO space, but outside that, we don't.
Okay. Budget. Any particular expectations that the government is certainly going to do, that's something that the market is already pricing in or is concerned about?
So I think markets will look at a few things. First, they will look at the fiscal deficit number. The projection is 4.4. It can slip to 4.5. But even if it's 4.5, I think the markets will be by and large okay with that.
Which is what is projected right now.
Correct. Yeah. Second, they will look at what is the future commitment. We would prefer government to slow down a bit on the fiscal consolidation because the country needs growth to pick up. Now, if they do that, how does it do that? If they were to promote capex, whether the government will do more capex on their own books, or they will encourage the household to build real estate, or they will continue to give production-linked incentive to corporates in the areas of electronics or electric vehicle or other things. So where the incentive flows, is that what we will wait and see. We don't know yet, but we would expect, given the path that is the government is going through, we would expect some incentives for the capex.
What incentives for the capex? Because you're excited about electronics, I know that. What exactly do you mean?
So exactly what government will do, frankly, we also don't know.
Prediction. You've been in this space for so long. Yeah.
Sure. So incentive will be that if you take a step back and look at last few years, firstly the incentive was just for assembling. Now the incentives are coming for backward integration. So we are looking for incentives which will encourage the companies to invest in technology, have partners, and have backward integration. For example, let's just assembling a mobile phone is not enough. Mobile phone has other value-added components like display, camera, backward integration to that, government's approval, incentives to drive that is what we expect to happen.
Okay. I wanted to talk to you about pharma. We're out of time, though. Thank you so much for coming. I appreciate that. Rana Gupta of Manulife Investment Management. All right, we're counting down to the market open in Mumbai. We're back in 2. Don't go anywhere. Welcome back. It is time for the markets in India to almost open. It's pre-open time. We're looking at Nifty 50 down just a bit, 0.13%. Well, both of them, 0.13%. One down, one up. That's the dollar is strengthening against the rupee, by the way. We're watching this space very closely. The uncertainty around U.S. tariffs is a big concern for the rupee. The Nifty also, general uncertainty around geopolitics and also the earnings season, perhaps not as good as one is expecting. It's early days with the earnings season, so we'll have to wait and watch what's going to happen with the Nifty. Let's look at some of the movers in the Indian markets today. Shares of Tata Steel, the Indian steel giant, posting record quarterly crude steel production in India thanks to higher output at its Jamshedpur and Kalinga Nagar facilities. Crude steel production rose 12% year on year to over 6 million tons in 3 months ended December 31st. Now, we have a special focus today, a new LinkedIn report offering a rare look inside India's job market. And it shows growing anxiety on both sides of the hiring table. 84% of professionals say they feel unprepared to find a job in 2026. And 3/4 are actively looking for a new role, with most saying the search has become tougher over the past year. Recruiters are struggling too. 74% say it's harder to find qualified talent, even as applications per open role have more than doubled since 2022. AI is reshaping hiring fast. 94% of Indian professionals are using AI in their job search, but many remain unsure how it's being used by employers. So which skills and rules and roles really matter now? For that question and many others, we have with us Ruchi Anand. She's the Vice President at LinkedIn Talent Solutions APAC. Ruchi, it's such a pleasure to be speaking to you. You know, the biggest question when you talk about India has been for a while now, jobs and more data that gives us a sense of what's happening there. So I really appreciate you coming and speaking to us. I want to start by your biggest takeaway from these findings that I just read out.
Amitoj, firstly, thank you for having me. Good to see you. And coming to the report, I'd say that one of the key things for me that stands out clearly is that we are in a phase, or when we talk about AI, we've moved from hype to handbook. And the reason I say that is because AI is now part of the job seeking journey as well as the hiring infrastructure across the Indian job market. Now, means that AI is clearly influencing how people discover jobs, how they prepare, how they apply, as well as if you think about it from an employer point of view, employers are also using AI to screen and select. Now, let me break down the report. And as you've said, that what's the sentiment like? Now, what you see on the screen, 94% of professionals are using AI in their job search. That's clearly because today, for a job seeker, AI has become a part of their, toolkit, or let's say the career toolkit. But before I get to that, I want to also just take a step to say that where are we in the market right now, and how AI is impacting overall. One thing is very clear, that by 2030, 70% of the skills required to do jobs are changing due to AI. And that's why we always say that your job is changing even when you're not changing your job, right? Because there's so much of skills shift that we're seeing. And which means when we think about employers, they need to therefore focus on, and they are focusing on, finding AI skilled talent who can directly influence business outcomes. And that, Amitoj, is because it's becoming more and more mission critical today. When we look at hiring success metrics, organizations now no longer measure their cost per employee or cost per hire. They're actually moving more towards revenue per hire, where productivity becomes a key metric. And that's where, when I break down the report into, let's say, a few parts, let's talk about, like I said, what do the job seekers feel at the moment? Job seekers, like I said, they are using AI in their toolkit. They are using AI to prepare for interviews because that helps them to be more confident. Around 1 in 3, let's say 31% of Indian professionals are also dedicating time to learn these skills, because we spoke about the skills shift, right? And they need to kind of stand out. But
Okay.
the impact, go ahead,
Yeah.
Amitoj.
No, sorry. This is mind-boggling. Let's take a step back for a second. How did you do this research? How data-proof is this research? Should people be like, okay, if you're saying that 84% of professionals in India feel underprepared to find a job in 2026, well, Indians generally feel underprepared for it when they're trying to find a job. I think that's a social thing on this side of the world. So just tell us a little bit about how you did this.
So this research, of course, is through our platform, and we've gone through this research is with members as well as over 6,500 recruiters, or almost 20,000 members that we see across when we do especially this research in the beginning of the year across segments. Coming back to in terms of being underprepared, I'll see that the same thing when we've done last year. This year, I think there is a little more sense of, this sense of anxiety, because while people have now, when I say hype to handbook, they have started using AI, there is a bit of, question in everyone's mind that how do I make sure that I'm applying, and with AI, is my profile being screened? Am I getting that opportunity? Do I get to hear back from employers? So that definitely is there. But I think that the way we look at what this is telling us is that the job market is more deliberate right now, rather than, it is opportunity rich, I would still say that, but it's even employers are looking at very specific, more deliberate roles and hiring in that way. So underprepared is, I think there is this sense of, I know I need to have more newer skills. I need to keep investing in myself or upskilling. I think that's adding to, the anxiety, like you said, that Indians tend to feel that they're underprepared.
I want to ask you to dive a little deeper into when you say, how are they using AI? You're saying everyone is using AI. Recruiters, job seekers, both are using. I want to know how exactly. What do you qualify as using AI? Using ChatGPT to make my resume? As somebody who's recruiting, using ChatGPT to understand what kind of talent or skills I need for a particular role? What's the exact analogy there?
Sure, happy to break that down. If you think about, let me first talk about job seekers. Let's say when they are using LinkedIn as a platform, there are a lot of AI tools that are available to job seekers. One is also around, like if we think about it, how do I look for, first let me talk about discovery of job. how do I discover the right jobs with use by AI in natural language to kind of say that I want to look at a role in finance, but in the environment sector, more specific around what I want to look for. So how do we make discovery of jobs easier? One is discovery. The other is preparing, right? The other is how do I learn new skills on, for example, again, with AI powered interview prep as well as coaching, on LinkedIn Learning, for example, that's where we're seeing users use those. In fact, I must also say that Indian talent, if you look at LinkedIn Learning data, is 2x more learning hours that they put in, right? So on the aspect of getting prepared or using AI and also using AI coaching. The other thing is using the platform as a job seeker for job match features. So it's not just today that I just need to, earlier it was all about velocity. I need to apply to a lot more jobs to be able to get like one shot in. But today it's about being more specific and also having awareness that if I'm applying to these roles, what is the percentage of my skills match at the moment, which is what, on the platform we are trying to do with the help of AI. And that is what we're trying to help job seekers be more intentional and clear with where they need to go. On the recruiter side, you asked, yeah.
No, go ahead.
Yes, Amit.
Sorry.
No, I was just pivoting to the recruiter side, right? So again, on the recruiter side, how AI is being used, of course, AI is being used, I would say, I think the general perception is that AI is being used to just shortlist, but I think it's not just to shortlist or to eliminate. The way LinkedIn, the hiring assistant, for example, the AI tools is being enabling our early adopter customers is to expand talent pools. Because let me go back to the point of we are in a very skills first era, skills first economy. It's important when we are not looking at jobs as just a collection of titles. It is a collection of skills. So if you think about it from both aspects, from the job seeker as well as the recruiter, it's going to be critical to be able to expand talent pools and really think about how do I look for candidates beyond what my traditional hiring methods were. So AI is enabling that. And it's beyond using, like you asked me, is it ChatGPT? It's beyond using that. It's using AI tools specifically in the flow of work of recruitment and job seeking. So yeah, those are some examples.
Yeah, no, fascinating. I want to bring up this particular graphic based on your own research. LinkedIn's India Jobs on the Rise report. Jobs on the rise. Following other jobs. Prompt engineer, AI engineer, software engineer, top 3. But then there's a healthy demand across sales and brand strategy, cybersecurity, advisor roles. Founder is very interesting. Okay, this is, I mean, yeah, sure, India has many engineers. But do those engineers in India meet the skill set that these jobs on the rise is reflecting?
So overall, Amitoj, I'd say this, that for all of us, I would say reskilling, upskilling is the need of the hour. So to your question, are those engineers meeting the requirements? I think the people who are staying ahead of the game to invest in themselves and look at what skills or what's the skill stack that they currently have and what's the skill stack that's required. They are of course making sure that they are constantly there, because it's going to be a continuous process, right? So that's one part. In terms of what you see is there are tech roles. Of course, tech roles continue to be on the rise, even as per this report. But there are also opportunities that we're seeing in manufacturing, retail, healthcare, right? So those are also industries and roles over there that we're seeing that are opening up or continuing to grow, rather. We're seeing a lot on the business growth and strategy advisory roles that are continuing to grow, as well as, of course, the very human-centered roles like teachers, psychologists, behavioral therapists. These roles are also something that we're continuing to see a rise in.
I want to tell you a quick story. The reason, it was a light bulb moment for me when I reached out to you and your team to ask you to come on our show was when Prime Minister Modi posted on LinkedIn. And he posted all the structural reforms that they've brought in, that was quite something, I thought. And in that context, one of the concerns that even India's IT secretary told us in an interview was that reskilling is important. Then there's this other concern about H-1B visas, which has been triggered by, all the US policies. Then there's this thought that, hey, GCCs are coming, so that's going to offset all of this. I don't know how LinkedIn looks at this, what you can say to bring those who look for jobs in India some idea, or even those who want to hire in India.
So I'd say that, of course, this is, like I said, it's an opportunity-rich time, but a lot of deliberate hiring that's happening. And going back to our role as a platform, I mean, you've of course mentioned Prime Minister Modi. I think for us, this is a great signal that the platform's role in shaping global conversations, that is also a very trusted platform where there's a lot of credibility to have these conversations, and world leaders are actually sharing on the platform. In terms of, for us, I think I go back to one thing, Amitoj. What really drives us is to create economic opportunity for every member of the global workforce, and that has been that's been the guiding light behind everything that we're doing on the platform, both on the job seeker side as well as connecting them to the opportunity. Be it, like you said, in India, is it the GCC opportunity that's coming up? How do we make sure that we are not just helping them discover, but more importantly, get them ready? So there's a lot of work that we continue to do in terms of upskilling as well, partnering with colleges, partnering with policymakers, governments. For example, like there was an example you talk about GCC. So for example, there was a Kerala Skill Summit a few months ago. Over there, how we've kind of made sure that we are giving more and more students and people access to skilling courses, unlocking a lot more courses, as well as making sure that there are roles that are there that are being serviced on the platform.
Okay, one thing that stood out was LinkedIn data saying applicants per open role more than doubled since early 2022. Fascinating. Thanks so much for linking with us, Ruchi Anand from LinkedIn Talent Solutions. It's been a wonderful conversation, and I'm sure we'll get you back very soon. That's all the time we have today on Inside India. Keep watching CNBC.